This week we're going to find out if recession has been naughty or nice, so stay tuned. Welcome to another local market update with Rick Batista. Welcome to our first weekly market update of May 2023. Now, there's so many things going on in the economy right now. The Fed's going to be meeting this week, and we should be seeing some information come out about inflation. And with the economy slowing down, the big question is, what's the Fed going to do, especially when it comes to rates? Again, so many things happening in and around housing that I'm committed to bringing you weekly market updates because monthly just doesn't cut it. The times, they are a-changing, folks. Today's video discusses both national and local data. The local data we'll share in just a bit is for all of Chicago proper, that's 77 areas. And although we do service all of Chicagoan and including dub burps, later in this video, we're only going to dive into the city's data. So let's get started with a fun fact and we'll share some other info and insights. Fun facts, market time. A lack of existing home supply has allowed U.S. home builders to capture a near-record share of housing inventory. According to the National Association of Home Builders chief economist Robert Dietz, 1/3 of current housing supply is new construction, far above the historical norm of 10%. With only 2.6 months of existing home supply as of last measure, prospective buyers have been increasingly turning to the new home market, which, along with builders' use of sales incentives, have helped support new home sales in recent months. Certainly some good news there, because we can definitely use new inventory across the country. Now let's talk recession. During the last Federal Reserve meeting, one thing that did come out of it was talks of a mild recession starting later this year with a recovery over the subsequent 2 years. So strap in, folks. This is probably not something that's going to clear up really very quickly. For so many of us, when we hear the word recession, the first thing to cross our mind is just that, the economy slowing down. But back in 2008, the recession took on an entirely new meaning because it was a very different situation where the housing market caused the recession, which is very different from modern times. But back in 2008, the housing bubble burst, and what ended up happening? So many industries were drastically impacted, which in turn impacted so many individuals and households. At that time, I was involved in a few different fields at the time, so I'm speaking from my own personal experience besides having looked back at the economic history of it all. But at that time, I had just gotten out of the world of credit and finance, where it had gone from personal to mortgage loans, very different worlds. First seeing the shit show of what was being allowed with mortgages a few years before 2008. Then after I left that world, I got back into real estate full-time. Perfect timing, I know, right? While helping run our family HVAC business. And for those of you who may not have been old enough to remember those years, real estate was starting to take a big hit going back to 2006 and 2007. That's when things really started to kind of transpire. And once the shit hit the fan in 2008, we really started to see the impact across the board. But that was then. Here we are 15 years later. Different times, different economy, different regulations, certainly different regulations and different markets. So the big question today is, how would housing be impacted by a recession? Well, we certainly can't control what's happening in the world and we can't predict the future, but we can take a look at what has happened and what is happening and help shape some likely possibilities. To understand how recessions impact the housing market, here's a quote from Bankrate. During a traditional recession, the Fed will usually lower interest rates. This creates an incentive for people to spend money and stimulate the economy. It also typically leads to more affordable mortgage rates, which leads to more opportunity for home buyers. So there you have it, folks. I can end the video here, right? History has shown that typically recession leads to a more advantageous atmosphere for buyers, but let's take a look at a little bit more information to get a better understanding. So let's review some pros and cons of buying during a recession. So I'm not going to read everything on this slide here, just the headers, and feel free to give me a call. We can always discuss these at greater length. But some of the pros of buying during a recession: less competition, lower prices, and lower rates. Some of the cons: stricter lending requirements, fewer options available, and economic uncertainty. So although a lot of the headlines of mainstream media, I would say the authors are called doom and gloomers, they do a wonderful job of trying to scare everybody to the point of paralysis, but life still goes on no matter how the economy is going. Obviously, life may be a little bit better for some than others, but life still goes on. The industry still goes on. People are still moving, whether they're buying or selling or renting. So we want to do our best to share this information with you so that as we approach these times and have to live through them, how are we going to handle them? We can help you get a better understanding so that you know how to better handle your situation in your household. So let's take a look at history a little bit more, going back to 1980. And if you yourself lived through all these decades as an adult, or parents or grandparents who did, reach out. I encourage you to have a conversation with them and see. Folks who are older definitely have a benefit of having a little bit of wisdom and experience on their side. So, find out from them, how do they live through economic downturns, upturns, and all these challenging situations. I hear so much in the news now that we have to wait. Well, what are we going to wait for? Things may not always get better the way we want them to, and things may get worse. We don't know. We have to make decisions based on the information we have now, while keeping in mind what our goals are, what our timeline looks like. Life has to keep on moving, folks. But looking at this chart here, recession does not mean falling prices, at least not always. Going back to 1980, you see where the last 6 recessions that we've had, and 2020 we had a small recession there, home prices have actually gone up. The last 2 recessions where prices went down was back in 1991 and 2008, that one that kind of sticks out like that. Big old red sore thumb. Again, very, very different times in 2008, so please, it's so easy for mainstream media to reach back to the most recent horror story and try to apply it to today, but that's just simply not the case. And looking at this next slide, what has a recession brought us? Falling mortgage rates. Again, looking back to 1980 and 81, they fell significantly. They were much higher too. And that's another thing you can talk to your parents or grandparents about, when rates were close to 18% back in the 80s. And guess what? People were still buying and selling. And I'm sure a lot of those people who had property ended up seeing some nice profits, even though they bought at a time when rates were high. They were able to refinance, et cetera, et cetera, et cetera. So taking a look at history and where prices have been and where rates have been during recessions or just after recessions, I think this kind of falls under the category of bad news is good news, right? Bottom line, recession does not equal housing crisis. But I understand, we all have our trauma triggers, and 2008 certainly is one of those triggers for so many who lived through those times. But again, I want to stress this is a very different situation, and overall, especially in this country, we've created such a stronger foundation, which makes the housing market so much stronger than the one that we saw just 15 years ago. As I mentioned, there was a ton of funny business going on, and I myself, when I was working in credit and finance, working in collections for second and third mortgages, very rarely were we the first mortgage, helped unveil a mortgage fraud ring when I was working downtown. People were purchasing homes on the south side with no doc loans. Very, very simple, very similar template for each of these deals. They were using the same situation as far as employment, being self-employed, same lender, same appraiser. Then they'd go and cash out a second mortgage right away, and who knows how tangled that web actually became. But thanks to jerks like that, there came to be so much more regulation in the mortgage industry. And love it or not, there have been certainly a lot of pros that came out of the stupidity that was allowed to ever happen in the first place. And as a result, today's housing market, again, is a strong foundation and so different than the housing market that we saw that led to the 2008 pop. And to further support the claim that the housing market has a much stronger foundation than years past or recessions past, let me show you something. Today, if we take a look at all the active mortgages out there, as of the fourth quarter of 2022, just over 80% of mortgages are at 5% or below. Let me repeat that. Just over 80% of all mortgages out there are at 5% or below. On top of that, next slide shows that Americans are sitting on a tremendous amount of equity. 68.1% have paid off their mortgage or have at least 50% equity. 29.4% of the mortgaged homes have 68.1% have paid off their mortgage or have at least 50% of equity. That is shown here in the pie chart with the green and blue slices. 31.9% of mortgage homes have less than 50% equity. And with more equity comes a little bit more power. That's why you get into the housing game. And that's the power that you have being a homeowner versus a renter. I'll say this a million times over. Renting is not for everyone. Homeownership is not for everyone. You have to make the best decision for you and your household. But overall, housing and homeownership, time and time again, have proven to be far more beneficial financially speaking than renting. And to wrap up here before we get to the other data, keep in mind that 6 to 7% is a fairly normal range for mortgages. Around and less than the 3% for the masses was just a unicorn that we had the opportunity to discover in our lifetime. And I'm not telling you that we're never going to see those rates again, but don't hold your breath. Don't wait till the rates go back down to make your next move or even enter the world of homeownership for the first time. Now it's time to wake up for the moment you've been waiting for. So this information and data is provided by the Chicago Association of Realtors. It is covering the week ending of April 22nd and current as of yesterday, May 1st. From fun facts to quick facts, we are looking at year-over-year changes. New listings in the detached home market down by 10%, attached being condos and townhomes down by 36%. Under contract up by 0.4% in the detached market, while the detached was down by 14.4%. And homes for sale year-over-year change down by 0.4%. We've seen that in the negative side of things the last few weeks. That's for the detached market again, and attached down by 31%. To unpack those numbers a little bit more, new listings, we wrapped up the week of April 22nd with 369 detached single-family homes, bringing us to a 3-month average of 306, down by 16.5% year over year, and the attached market 565 with a 3-month average of 495, down by 36.3% year over year. Under contract, we wrapped up the week of April 22nd with 233 single-family detached homes, 3-month average of 199, down by nearly 18% year over year. Attached market was at 368, 3-month average of 335, and down by nearly 34%. Inventory of homes for sale, we finished up that week with 2,071 single-family detached homes, bringing us to a 3-month average of 2,269, up by nearly 11% year over year, and the attached market 3,029, 3-month average of 3,102, down by 27.1%. So, what does all this information mean for you? Heck if I know. All it depends on what's going on in your life and your household. Let's start a conversation and see how we can help you make the most informed decisions. If you like copies of any reports or slides that we shared with you today, feel free to reach out. You can call, text, or email. My contact info is below. And remember, love and money may come and go, but time is something that we never get back. So I thank and appreciate you for sharing some of your time with me. If you want to stay on top of the market with us, be sure to subscribe and hit the notification button. Take care of yourselves and each other, and I'll catch you next time.